Thanks, James, and thanks for having me back. It's a wonderful event and a wonderful business that you and Tom are running, and I'm sure a lot of people here appreciate all the hard work that you put in. A lot of people ask me when they come to invest with us at Forager, tell me what you think your edge is. You have a very small team of people, you sit here in Australia, you invest money all over the world. What are you doing that lets you make outsized returns from investing in equities? And my answer to that is pretty simple. We don't have a big team, we don't have an informational edge, we are not smarter than the very, very smart people that we compete against in this industry. What we have is the emotional fortitude, the business structure, and the client base that allows us to take advantage of other people's irrational behaviour. We are not trying to out-analyse other investors, we are trying to use our emotional edge to act when other investors can't act. So this investing psychology is really at the core of absolutely everything we do at Forager, right through from the idea generation phase. So people say to me, well, why do you look at stocks that are down 80% over the past 12 months? Now you might as well look at stocks that have doubled. And my answer to that is, well, people hate losing money. So when their stock is down 80%, they will sometimes do things that are irrational. Not always, but sometimes. We use it when we think about portfolio management, and we use it when we think about selling stocks as well. I put a few books up on the screen here. I'm not going to get into too many of the technical details about investing psychology today. There's a lot of information out there. You can read about it yourself. There's 4 books up there and a collection of essays by Charlie Munger that Adrian just mentioned. I do want to touch on one thing if you're scribbling a few of them down though. That first book up there was the first one that I was introduced to that really explained to me how our brain can be fooled into doing really stupid things. And I read an interview with Robert Cialdini a few years after this book had been wildly successful, and he was really disappointed with what had happened because he wrote the book. It's all about consumer psychology, not investing, but a lot of the principles apply. He wrote the book to protect consumers from marketers that were trying to flog them products using these psychological tricks. And what had happened was that a whole heap of marketers bought the book and used the tricks that were in the book to sell even more product to the people who didn't want it. And you actually need to think about this because it's really applicable to investing. There are people like me going around out there looking for your psychological weaknesses. It's the way that we invest money and the way we think about it. And we're actually out there looking for an edge, taking advantage of other people. Who's been watching the show Billions? Well, quite a few people in the room, so you'll know who I'm talking about. This woman on the screen is Wendy Rhodes in a show called Billions that's on Stan, and it's about a hedge fund. It's a fictional show, but very loosely based on the life of Stephen Cohen, a famous US hedge fund manager, and Wendy is his full-time psychologist. She works in the office with all of the investors, and she tries to help them behave rationally, to not lose their minds when they're losing money, and to do the right thing. Now, we can't afford a Wendy Rhodes at Forager, so we've done the next best thing and got a cardboard cutout and stuck her in the corner. Actually, that's not true. We don't have that either. But we have a room that we call the Wendy Rhodes room, and we think about this investing psychology. And the first person we got Wendy to analyse was me. And we sat down and said, let's have a look back at the past 10 years of running this business. What have you done well and what have you done really poorly? Where are your psychological strengths that we can use to advantage? And where are the weaknesses that we need to protect our clients from? So I'm a generally unemotional person. My wife will be the first to back that up. I think probabilistically. Now, I heard Catherine talking about China earlier, and she said our estimate of the probability is probably gone up from 5 to 10% of there being some sort of trade war there. I really like that type of language. Most people want to get up there and do a presentation and say, there is going to be a trade war or there's not going to be a trade war. Thinking about the world in a probabilistic way is really important, and it's something that I do very naturally. I have very minor loss aversion. I grew up on a farm, so making losses was just a part of everyday life. And the psychology is people feel the pain of a loss much more than they feel a benefit from an equivalent gain. And I am quite capable of absorbing losses. It doesn't cause me the same sort of pain that it causes a lot of other people. And I'm naturally averse to the bandwagon bias. I went to the Berkshire Hathaway meeting back in 2006 it was, so what's that, 12 years ago? And I felt decidedly uncomfortable. You know, there are 30,000 people there in a crowd pretending that they don't follow the crowd. It's a bit of a bizarre situation, that one, and I didn't feel comfortable in it. Now, I have some weaknesses as well, and those weaknesses are often closely correlated to the strengths. Something that I do wrong very regularly is what is called anchoring, and a lot of value investors fall into this trap. You see a share price that was $10, it's fallen to $1, and you think, wow, this has to be cheap, because you're anchored to that price that you saw at 10, and subconsciously your mind is going, well, if it goes from 1 back to 10, I'm going to make 10 times my money. Commitment bias, another very common value investing problem. Contrarians always want to think the crowd is wrong, and I think one of the big benefits of following the crowd is if the crowd changes direction, you're quite happy to do the same. Everyone just runs off over here, and well, I'll run off over there as well. And you're more willing to change your mind than someone who goes against the crowd, because you're standing out there on a ledge and you're being different to the crowd, and you want to be right about that. And you need a certain psychology that says, well, I am right and everyone else is wrong. And that creates this commitment bias of being too committed to your ideas. James already touched on this. I'm a competitive person. I think that probably makes me do too much. If I look back over the past 10 years, I think we could have benefited from actually doing less and showing more patience. And it's something that I've surrounded myself with people who make me slow down all the time, because I get excited about falling share prices and I want to do things. And we've surrounded me with a process and a team that says, well, okay, let's just slow down here and do the due diligence. I said earlier, I don't want to get too much into the technical details. I am going to talk about how we apply this in our daily life, though, and I've got 3 examples. When we were doing the rehearsal for this yesterday, James said, well, Steve likes talking about his mistakes, and someone much less kind than James said to me, well, if you didn't talk about your mistakes, you wouldn't have anything to talk about. So we're going to start with one of the big mistakes that I've made over the past few years, and it was in the very early days of starting our funds management firm. I don't know how many people remember this, but the name of the company was Photon Group. It's actually still listed, changed its name to Enero. And this is the share price chart from 2004 up until 2007. Now, given what I've said my strengths were, you can probably imagine that this wasn't a point where we got caught up in this stock. I don't like rising prices in general. I don't like following the crowd. But I did want to put it up there because there are many psychological problems going on, but the main one is one that I see more commonly than anything else, and that is the narrative bias. Human beings are wired to like hearing stories and explanation for things more than they actually like analysing the facts. It's a really simple thing for your brain to do, to say, well, that story sounds good, I'm going to buy the stock. And you'll hear a lot of it at conferences like this, people talking about China growth stories and the China consumer and all sorts of things, that electric vehicles are going to grow, go and buy the stock. And it's a real trap for investors that I see all of the time. And how do you know that you might be suffering from the narrative bias? I've got a really simple rule of thumb. If you can make the same argument at any price, then you might be susceptible to the narrative bias. I'll give you a really quick example. Sydney property prices cannot possibly go down because there's a limited amount of supply and it's a growing population. I say, okay, that's an argument that makes logical sense, but I could make it for if my apartment was $1 million. I could make the same argument if the apartment was $5 million. I could make the same argument if someone was trying to sell me the apartment for $50 million. You can make the argument at any price, and any argument that you're hearing for buying a stock that doesn't have a reference to price, you may be falling for the narrative bias. Okay, like a lot of these roll-up stories, so Photon was a marketing company. It had a very charismatic person running it, Tim Hughes. They were running around buying marketing agencies. The typical story that you hear a lot, buying these things for 4 and 5 times earnings, the market's valuing them at 12. Every acquisition they do, the share price goes up. It was new age marketing, digital in every second word that they used. And then, of course, it came unstuck and the share price plummeted. Now, this is where things start getting risky for me, because I like to take advantage of falling stock prices. I start getting excited. And I made 2 very bad mistakes. The first was being anchored to that share price. Now, I've put the price up in today's dollars because it'll make sense to people who know Enero today. It's had a 20-for-1 consolidation. So back at that point in time, the share price had fallen from $6 down to $1. I started getting excited. And we did a lot of analysis. I can give you all sorts of reasons why we bought the stock, but looking back at it, the fundamental reason was I'd seen it fall from $6 to $1, and I thought it must be cheap. I was anchored to that $6 price. Now, I made a second mistake, and that's confirmation bias, and this is when in a stock like this, okay, it's fallen from 6 to 1. I've already decided I want to buy the stock. But what I then do is go and gather all of the information I can that backs up my argument to buy it, and I subconsciously ignore everything that tells me my argument might be wrong. Okay, that was a mistake. We could have lived with that. We would have lost a bit of money and life would have gone on. But we made a horrible second mistake, and that was to double up on our investment. So the company got into a lot of balance sheet trouble, and when we bought it, it actually had net cash on the balance sheet, but they came out and said, look, we actually owe all of this money to people that we've bought businesses from that we hadn't told you about before, and we misestimated on the balance sheet, and now we've got a liquidity problem and we need to raise capital. And we should not have put more money into this business, but we so wanted to be right. And this commitment bias, I've bought the stock, I've told my clients about it, I've told them I think it's a fantastic idea. You just want to be right. And again, we go off and we build fancy financial models and we believe management forecasts that we never would have believed on the way up because we want to be right. We still own this stock, so that was 2010. It's now 2018, and you can see how it's performed for most of the past 10 years. We still own it because I think the business is worth more than today's share price. But it's been a really disastrous investment, and yeah, it's humorous, but it cost my clients a lot of money. And we've done a lot of work into thinking about how we stop making mistakes like this. So we're going to move on to a successful one. This is Service Stream, which has been our most successful investment ever at the other end of the spectrum. And I don't want to delve into the whole lifespan here, but I want to focus on one particular point in time. We bought this stock in 2013. We had a view that it had two businesses that were worth more than the 20-cent share price at the time, and it had a business contracting for the NBN that we really did not know what it was worth. We thought maybe zero, maybe something, maybe a little bit negative. We're not sure, but we've got this more than 20 cents from the two stable, reliable businesses that's underpinning our investment decision. We sat there for 2.5 years, and as you can see, the share price didn't move, and they put 5 halves together in a row that were pretty good. Revenue was growing, this NBN division was actually starting to make a bit of profit, and the share price just didn't move. And then all of a sudden in 2016, it went from 20 cents up to 50 cents. And this is a really, really dangerous time. In fact, we had our finger on the sell button. We're sitting there saying, okay, we had 5-6% of the portfolio in this stock when the share price is 20 cents. It's now 11% of the portfolio. Why would you have more of the portfolio in a stock that's already doubled? Very close to selling it, and I get a tap on the shoulder from Wendy Rhodes, and she drags me into the side room, and she says, Stephen, that's what my school teachers used to say when I was in trouble, Stephen, what are you doing? Are you anchored to that 20-cent share price? Because you know that is irrelevant now. What matters is what's in front of you. And I said, well, probably yes. And then we had a bit of a chat about informational bias, and my last 2 points here are going to be about something a little bit more subtle in investing psychology, and it's how we process information. And there's 2 really important rules. A, we tend to overestimate what's most recent. You see this in quarterly earnings all the time. You know, companies been listed for 20 years and reporting results for 20 years, and they put out one quarter's results and the share price is up and down 20%. I'm going to talk about that on my last slide. The other point is that we tend to underweight really significant information. So we've got these models in our heads. Business is worth 20 cents a share. Piece of news comes out, quite important. We find it very hard to move our valuation by more than 20%. And you often see this, a company will sell a division that means it's paid off all of its debt, or it sells a division that's more than the whole share price at the time. And you see the share price jump 20 or 25% when it should have jumped 100. We are not very good at processing those really important pieces of information and updating our probability. And that's what we were doing with Service Stream. Now, this NBN division, we had said it's worth 0, and we thought the stock was worth 50 cents at 0, and it was quite clearly worth something at that point in time. And my inner Wendy Rhodes says to me, clean sheet of paper, what do you think the stock is worth today, and what is the right portfolio weighting? We knew this business inside out, so we sat there and said, well, it's probably worth 90 cents or $1, and it probably deserves a higher weighting than when we first invested in it. Go back out there and do absolutely nothing. Now, we put months of work into this stock before we bought it, and we would have made plenty of money, but we made more money. We actually sold the last of our shares in May, a month or so ago, at $1.60 a share. We made more money by that decision not to sell it, which was driven on psychology, than we made by the original investment decision to invest in it. Okay, one final example, Blanco Technology, and this is an example of what we call recency bias, making decisions and overweighting the most recent piece of information you've got. A really quick narrative on the stock. This company is a global leader in erasure software. So large corporates like the banks, they want to dispose of a tablet or a computer or a phone. They want to make sure that the hard drive is properly wiped. If you hit delete on your computer, someone who knows what they're doing can grab your computer and actually dig out all of that old information on it. You know, pretty good story, right? Global leader in that business. You know it's growing. You know it's going to keep growing with all these privacy demands, particularly in Europe at the moment, and the company had been doing very well for quite a long time. Great story. Everyone's scribbling it down. They want to get on board. And then we were in London August 2017, and the narrative was, well, this company had had a new CEO for about 18 months. He had put out profit forecasts. He'd fudged the accounts to hit those profit forecasts. He then sold all of his shares, and the company hadn't actually been able to lodge its accounts for the year because they were restating the revenue from previous years. Pretty horrible piece of news, right? Like, who's going to buy a stock in that sort of situation? But I sit there and say, well, okay, that is a piece of information, and it's the most recent piece of information, so people are probably overreacting to it. The share price was down 80%. This business was trading with a market cap that was about 1 times its revenue at the time, and most of these sorts of businesses are trading 5 and 6 times revenue. So we did a bit of digging. We actually met with the company's representatives here in Australia, and we said to them, how do you generate your leads? And the woman said to me, I don't generate leads, they just ring me up. She said, and we do not have enough people to deal with the business that we're doing here. So the product was real, the growth had been real, albeit not as high as the management had pretended, and we thought it was a pretty attractive business that was being overweighted by the most recent piece of analysis. Okay, that was it from me. I'm going to pass back to James, but as he walks up, I just want you to have a little think about yourself, your own strengths and weaknesses, and where you might be able to improve your investment process as a result.